Hello and welcome everyone to the Capital Mind podcast. If you'd like to know more about us, visit capitalmind.in, and if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capital Mind may maintain positions in the securities discussed in this podcast.
Hi everyone, and welcome to a new episode of the Capital Mind podcast. In today's episode, we take a look at the RBI actions from the end of 2023 and the impacts they're starting to have. We dive into the nuts and bolts of what the RBI has done with risk weightages and the restriction it has imposed on being both a lender and an investor. We see how this plays out with startups offering digital lending products like, say, Cred and Paytm, how this impacts BNPL and firms like Bajaj Finance, why your credit card limit might reduce, why the conflict of interest rules are a bit harsh, but why they've been created, why you need to watch out for AIF products being sold or resold to you this year, and finally, whether all this is a proportionate response from the RBI, and does it suggest that our economy is overheating? So do listen in. Well, hi Deepak and Happy New Year. I'd like to start off our first podcast of 2024 with something that happened towards the end of last year and did seem to start making waves, and it's continuing to do so now. So in layman's language, what I saw and how it was covered is that the RBI seems to have targeted NBFCs and banks with some new regulations that have essentially slowed down certain types of credit growth or disincentivized it, and in some cases, as we've seen in some public stock action, made entire lines of business not look attractive anymore for some companies. So this felt very interesting, and what great timing. Today, just as we were going in to record this, the RBI governor was doing a press conference or addressing an event where he added some more color into his thinking. So I figured we could take the events of December and this morning's, I think it was a Mint event, and just bring them together and ask you, since you are our resident RBI expert on these matters, let's start with this. What has the RBI done?
Excellent. Now, firstly, Happy New Year. I think this is going to be a very interesting year. RBI last year has done two things, and they did it in the months of November and December. The December one we'll come to later. But the first thing that they did in November was they told banks that, listen, we think you're growing your personal unsecured loans too much. Now, banks can lend to anybody, they can lend to businesses, but when they lend to you and me as individuals, they can either take a security against it. So a house, when you take a housing loan, or a vehicle, when you take a vehicle loan, is a secured loan. Whereas if you go to take a personal loan from a bank, a credit card loan, this is typically unsecured. They don't have any actual security. And if you default, they go after you. And therefore, whatever other assets you have, even though you haven't actually specifically secured them against whatever loan you have taken, they can go after that. They have to go after you in court to suffice and all that stuff. There is this part of lending which was personal unsecured loans, and RBI is saying, listen, don't grow it that much anymore. You guys have grown too much. My first reading of this was this only affecting the less than 50,000 rupee loans, because RBI was a little afraid of it. They talked about it 2 or 3 times. They said, how do you recover a loan that's less than 50,000 rupees if you don't have any control on the borrower? You're entirely digitally kind of offering these loans. You don't even know where the person lives. Microfinance loans are less than 50,000, but let's say you go to a person that's digitally, given his KYC and then taken the money. Your ability to recover is so small that you probably will be like, forget it. It's a 10,000 rupee loan. Just let it be. This creates a bad signal. And the other thing that RBI has mentioned is that they found that people have been taking more than one loan, evergreening themselves. This evergreening thing is one aspect, and they've applied the same thing to the second regulation, which is they're saying that banks and NBFCs, if they invest in alternate investment funds, they're investing in a fund.
This is the second one, right? The December one.
This is the December one. They said, you can invest in an AIF. The AIF can then effectively lend money to a company, which could have been a borrower of the bank or NBFC in the first place. So they're like, listen, if you do these things, we think you're evergreening the loan, passing it down to the AIF and then making the investing in the AIF and making the AIF invest in your company instead, which will hide an NPA away from you or change your exposure norms and so on. They've just said that if you do this, then you're either going to have to sell those AIF units, whichever you own, or you're going to have to ask the AIF to not lend to those people anymore. Now, these are complex consequences of these things. We'll explore them. It's a very interesting set of regulations. The biggest impact has come to startups, unfortunately. Let's maybe explore each of them, as we go along.
Yeah. So I thought you could talk about what is the mechanism with which they've done this, and what's the impact, and why should we care? I mean, sure, some credit growth has slowed down and so on, but why should we care?
Yeah, this is actually a great question, because the why should we care, unfortunately, comes down to how does it affect the common man, how does it affect the borrowers, how does it affect and one particular level of entity, which is startups, who were either facilitating lending or lending by themselves, have gotten hit quite badly. Now, remember that the first regulation is about personal loans getting a higher risk weight. Now, let me explain that regulation a little bit. The way the regulation is worded, it says, if you lend to an individual personal loan, so it's business loans are excluded, industrial loans are excluded, agricultural loans are excluded, but individuals also can have loans against housing and vehicles and gold and I think a couple of other things. They've kind of spared those, even education loans, even though education loans are relatively unsecured, but they said even that is fine. But when you do unsecured loans, so for instance, you take a credit card and then you say, listen, I want to take a loan against my outstanding on the credit card. So they give you a credit card loan. You go to a website like Amazon or Flipkart and you say, I don't want to pay all this money right now. I want a 3-month EMI, a 6-month EMI. That's effectively a loan, a personal loan for those 6 months. This is something that RBI said, when you do this, we believe that this part of the ecosystem is growing too fast, and therefore we're going to increase the risk weights on loans. Now, how much? So personal loans go from 100 to 125%. Credit card receivables go to up to 150% for banks. It was to 125% earlier. Now, you might be like, Deepak, what's the risk weight? So let me start with this. So let's say a bank has 100 rupee of capital, 100 crores of capital. 400 rupees sounds too small, so let me say 100 crores of capital. They now have to use that capital efficiently. What does that mean? It means I can take the 100 capital, and if I have to have a 10% in NBFC cases 15% capital adequacy ratio, that means if I lend to what are called my risk-weighted assets, and let's just assume you call them loans worth 1,000 crores, and if I have 100 crores in capital, I have 10% CAR. I'm an NBFC, I have to have 15% CAR. So with the 100 crores of capital, I can do 100 into 700 crores roughly. So I can borrow the remaining 600, I can lend 700, and I have 100 rupees of capital. This is great. Now, the way this works is that 1,000 crores is not exactly the 1,000 crores you lend. It's based on a risk weight of the loans. So I can take the 1,000 crores and lend it, let's say, to government entities. That is not even considered, it has 0% risk weight. So that means their capital is not impacted at all. You can lend another 1,000 crores outside of that. If you can, of course. It's complex, but assuming that you don't do that, you can lend, let's say, to a person buying a car. The car loan may be 100% risk weight. That means you can lend 1,000 crores against cars. But a housing loan has a 50% risk weight in certain circumstances. That means if I lend to, let's say, a small housing loan, a 10 lakh, 20 lakh, 13 lakh kind of a housing loan, I could do this up to 2,000 crores because it's a 50% risk weight. They take the 2,000 crores and say your exposure is 2,000, but its risk weight is 50%. So your exposure is 1,000 crores.
And against that, your 100 crore capital adequacy ratio is sufficient.
So I could lend 2,000 crores to housing, 1,000 crores to vehicles, and because certain like credit card receivables are 125%, I can only lend 800 crores to credit cards. So I'll have a mix of all of this. The mix of all of this determines how my capital is employed. So this is why housing loans are cheaper, right? So housing loans are cheaper because you could lend more to housing loans. The capital efficiency works. So for instance, if I lend 2,000 crores worth of housing loans and I make a 1% on that entire 2,000 crores. I'm making 20 crores. So my capital of 100 crores is yielding me 20 crores in profit, right? So that's 20% ROE. That's fantastic. But in order to make the same 20% ROE, I can only lend 1,000 crores to vehicle loans. So I need to make 2% net of all the taxes and all that in a vehicle loan. I need to make 3% credit. That's why credit cards are more expensive. They give you a 36% interest rate, and that's also part of it is defaults are very high. But just the fact that it costs so much on capital is another reason why interest rates are higher. Vehicle loans are at 10%. And housing loans are at 8.5%. The reason why housing loans are cheaper is because obviously the spread, you can lend more to it and so on. So the idea is if I increase the risk weight, the bank says, listen, let's not do more of this stuff. Let's do something else that's more interesting. So the idea now is two things. The amount of capital and the ROE that the bank has to earn. Typically, banks and financial companies, they earn between 10 to 15% ROE. Even an HDFC bank will earn maybe in its best year, it'll earn 18%, but nowadays it'll earn 14 to 15% ROE. That's the way the system works.
How much capital would they have? Sorry for the interruption.
So that's very interesting because if you look at, I think they're lending along with the merger with HDFC, they probably have 25 lakh crores of lending. I don't know the exact number. Maybe 20 lakh crores of lending. I don't know the exact number, but assume that they have 20 lakh crores of lending. They would end up being having a capital of 300,000 crores. So 3 lakh crores of capital perhaps, or close to that. So for them to have earned 15% means they're earning 45,000 crores per year, which is roughly what they do earn. So with 3 lakh crores of capital, they earn 45,000 crores a year. That's a 15% ROE. And this is considered good. For an industrial company, you want a minimum of 18-19% ROE, right? But for a bank, you're fine with 15% ROE. But the banks don't want to reduce their ROE. So at whatever reduces their ROE, they don't like. So the idea now, RBI is saying, I'm going to increase the risk weight of personal loans. You will find it unattractive to do personal loans. So you'll go into business loans instead, which is what I want. So,
or any of those other types of personal loans which aren't impacted, like
exactly.
housing,
education, and so on. Because education loans have not done well at all. To give you a rough idea, in 2011, of the total banking credit that was out there, 10 to 15%, and that's about been constant throughout, it has been to agricultural loans. So of the remaining, if you look at the split of the remaining, it used to be roughly 40% to industrial loans. Right, and then there's services and trade. So, for instance, services would be companies who are doing trading, wholesales, retail trade, aircraft transport, truck loans, and so on. These were all considered service loans to businesses, including to NBFCs. That used to be roughly about maybe 30%, and only about 25 to 26%, or whatever is remaining, it's about maybe about 26, 27% was to individuals. Now it's flipped over quite dramatically to the extent that there is 150 lakh crores. So 150 lakh crores of total lending. So let's say 1 lakh crore is 1 trillion. So I'll make it easier. So 150 trillion rupees of lending, out of which only 35 is in industry, which means it's just about 25%. 41, even greater than that, is in services. A good chunk of this is in NBFC. So I'll come to that NBFC part later. And that means banks lend to NBFCs. And then of personal loans itself is 46 lakh crores. So nearly 33% or 32% of total. So 25% is to industry, 32% is to personal loans. So personal loans have actually taken over and gone up dramatically. This is why RBI is more afraid, because it's grown very fast. This, according to RBI, will say, listen, let's if we reduce this amount to some extent, unsecured personal loans will come down over a period of time, and then we'll so the impact now starts to say, okay, if this is RBI's intention, some stocks are going to see damage. We've seen this happen in startups who have been listed and have facilitated perhaps lending to individuals using their digital framework. So you have an app, and you use that app to originate loans. But the loans are actually given by an NBFC down the road, and that NBFC does not have any digital capabilities. It's relying on the intermediate startup to say, I'll get you good people who can return the loans and I'll give them loans. So how much loan do you want? 5,000 rupees? No problem. We'll give it to you. Unsecured personal loans by NBFCs or by banks will go out the window. It has slowed a little bit now. What's happened is it was November. So we've got now data of November and December. What was growing at 28% annually, this has grown from 20% plus since 2021, roughly after the COVID, disaster. So it was growing even before that. So now it had gone up to 28% per year. Now it's come down to 22. It's still quite high, but I think it's going to slow down even more. From Jan 2018 to now, unsecured loans have gone from 4 lakh crores to 12 lakh crores. It's gone up 3x. Housing, which is another personal loan and used to be the biggest element of personal loans, has gone only from 9 to 21. So housing has gone up 2x and a little bit, but in 5 years odd, or now it's 6 years. But the unsecured personal loans have gone up 3x. So what RBI is saying is, listen, in the house at least you have a security. Why are we, going, so strongly in unsecured loans?
Two questions come to mind. They're a bit subjective, so this is more opinion than fact, I guess. The first is, what's the issue with personal loans? After all, these banks care. You're talking about how sensitive they are to their return on equity. So surely they care about defaults as well, right? So surely the RBI does not need to step in to save them from themselves. So why is the RBI so concerned about this? Can't we rely on, in this case, the banks to make the most risk optimum decisions for themselves? Or banks or lenders, in general. That's one. And the second is, do you have any view on the merits of personal loan growth versus house loan growth? Does it matter, in your opinion, which one is growing or not? Is one more productive than the other or something?
That's a good question. The productivity aspect is one sense, but let's look at this way from a perspective of... so let me answer the first question first. Why should personal loan growth or personal loan growth matter in any meaningful sense? I think... getting to a point where when you were a bank, now in the old days, banks were just places where depositors were giving capital to a banking system. That banking system was supposed to lend back to other people in the same community. The idea was, you take my money and give it to my friend as a loan, and you just front it so that I don't have to deal with all the repayments and all that stuff, and that's how you do it. But over a period of time, after the nationalization of banks and all that stuff, the government perhaps changed the mechanism of how lending was done. Then most of the loans went to the corporate area, and we'll probably come to that at a later point. But the issue of where we are right now is that personal loan growth is supposed to be growing. It was not supposed to be so little that it was never it was a concern. Most of what we are doing right now, what the RBI has done right now in the last 12 years, is to slow down corporate loan growth. The idea was that corporate loan growth was too much. There were too many corporates borrowing. In a typical banking system, the idea, and if you read the papers of RBI itself, at the time when the banks were nationalized, the banks were given a mandate that they need to lend to people. They need to lend to rural people, to urban people, set up small businesses, do whatever it is that it takes. People will return the money and so on. But banks have switched over and tried to lend so much money to corporates. Corporates have figured out how to misuse the system, to abuse the system, and so on. So until the IBC, the bankruptcy code that happened in India, the idea was a corporate would take a big loan, then it would default. Then the bank would say, sir, you can't return my loan. He would say, yes, sir, I cannot return your loan. Oh, fine, let's write off half the amount, and can we go back to what it was 2 years ago and keep doing business? So the promoter would say, fine, you're giving me half my money back.
Why not?
Why not? So it was, of course, there was less surprise and more wink, wink, nod, nod. But more of this was happening. So much of this was happening that at some point RBI was stepping in and saying, what are you guys doing? And they were like, no, this is how banking is. And said, no, this is not how banking is. We're going to change this. We're going to make banks take down corporate lending. So they spent about 8 to 9 years making sure that banks will not be allowed to grow lending insanely to corporates. Banks, on the other hand, banks figured out that this is no longer something that can happen.
I'll just pause here. And therefore, corporates are supposed to use bonds, right? The long-awaited, one day we'll all use bonds.
Yes. In fact, in the US, for instance, bonds are a large market. Everybody finances themselves using bonds, money market, commercial paper and things like that. Commercial paper is bought by mutual funds. Mutual funds are invested in by customers, corporates and so on. So they use that money for their short-term loans, long-term bonds. Even a Byju's in India, when it went abroad, it did not take a loan from a bank. It issued a bond, and that bond was bought by a bunch of financial institutions. The bad part about what has happened in India is that the bond market hasn't developed because corporates could simply go to banks and banks were willing to fund them. When RBI changed risk weights according to a bunch of things, suddenly the corporates started to realize that they can't do this, and the IBC came along with said, if you don't return your loan, we're going to take the business away from you. Yes, business can continue as usual, but it will not be your business. That put paid to a lot of plans. People start to reduce the amount of overall lending, and corporate loan growth didn't grow. So at some point, personal loan growth was growing. So, this was exactly according to what RBI was envisioning. So they were like very happy, except the problems, the lessons learned from the corporate endeavor were that, hey, we can do the same thing in the personal loan end. We keep lending. If they don't return, we'll sort of kind of wink, not write it off. But we don't have to, we can just give smaller loans, or we can give loans to people who we think will repay. And even if they don't repay, it's fine and all that stuff. First, housing loans started to develop. So that market started to move up quite a bit. In the 1980s and 90s, people didn't think of taking housing loans. And it later became very easy to get housing loans almost digitally as well, to the point where builders started to get housing loans with the house, in the sense that you would actually go to buy a house. The builder would say, listen, HDFC or ICICI has already approved our project. So if you are, your credit score is so much, you're going to easily get a loan for this house. All good. And I think there's a big problem festering over there also, but we'll come to that another day because RBI hasn't yet come to it. So as long as loan growth was happening at the secured end, everything was fine. This unsecured posed a bigger problem. This posing a bigger problem has complexities. Now, you might think that the growth comes because more people are borrowing. What if I told you that, listen, I'm Deepak Shenoy. I borrowed 20,000 rupees, at an interest rate of 20%. To pay that loan, I borrowed from another guy 24,000 rupees, paid the first guy. Then to pay that guy, I borrowed at 28,000 rupees, and I kept doing this over a period of time. You think it's growing, market is growing 20% a year, except it's the same guy just borrowing the larger amount, including the interest, and without the capability of paying it back ever, right? That is not growth, that is evergreening. So it's very difficult to distinguish between evergreening and loan growth. So if you find that the loan growth and the loan per person is equal, then you're not growing anything. You're just evergreening everything. So if we take loan growth over a period of time, it's 22 to 23%, but you know that the interest rates on these loans are also 22 to 23%, you may be seeing evergreening happening. And that, I think, is what RBI's worry was. It's like, you guys are growing it, but you know what? So is the interest rates that you're charging, and so it's likely that you're evergreening these loans in the first place. They have data as well that says we've seen the same borrower repeat their loans over multiple lenders. So they're like, okay, there is some evergreening happening here, so we have to slow this down. Unfortunately, some of the way the particular regulation is written is going to have a downstream impact even on loans against fixed deposits, loans against shares, because these were not mentioned specifically. So technically a loan against shares should not have a high risk weight because I have a security, but because the way regulation is written, loan against shares also sees a higher risk weight simply because of this. Now this is all fine if banks have capital. Banks need 10%, NBFCs need 15%. If you're 15% plus, that means you're like Bajaj Finance is 20%. So you're like, instead of 20% now because of the higher risk weights, they'll become 16%. That's fine. because you're still above 15 and you're okay. But there's some banks which were 16%, they'll go down below 15 now, and they're going to have to raise capital. So that's where the impact starts to come on the NBFC itself. And the NBFC, because it is going to be conducive about its capital, it's going to be a little stubborn about saying, why should we lend here? They're going to be like, let's shut down the lines of business that lend to personal unsecured and let's go lend against vehicles or something else instead. That is become the consequence of RBI's action, and therefore RBI wants to continue to see personal loan growth, just not at the unsecured level, more at the secured level.
Well, one thing which comes to mind, I'm sorry to interrupt, is that the way you're describing it, this is a very thoughtful action by the RBI, and it's an iterative thing. First they've done this, then they've seen this, and they're like, hey, this is happening, and I'll intervene here. But you don't seem as, if I may call it, equally positive about it as your explanations are sounding. They should be, right? It's like they're seeing this potential evergreening, they're seeing a certain type of asset growth go up too much, and so on. So why aren't you more positive about the RBI's action here?
Actually, I think here we do have a problem that in a financial system, you can't slow things down. I mean, you can try to, and perhaps, even the Fed has managed to do a soft landing and all that stuff. But slowing things down generally has a problem. I'll tell you why. For instance, an NBFC may not say, oh, let me just lend to lesser people. They will just say, let me shut down this business because this is not going to grow as much. So I want growth and I want high ROEs. So instead of lending 100 crores more here, let me find a place that I can lend 200 crores to somewhere else. In that process, what happens is, let's say there's a startup that uses that NBFC to provide funding to customers that they are sourcing. They're like, oh, these lenders are no longer allowing me to lend. Can we then, what do we then do? So the next option is for them to say, let me find a different NBFC. So guess what happened? A startup called Zest Money. Zest Money said, we have a bunch of lending partners. We have a bunch of people that are on our platform. They can get loans digitally, one click, just wave your phone in the air, and so magically money will pop into your account. Great service, great whatever, great product. But you end up with a situation where if they don't have an NBFC backing them, they don't have a business because nobody is out there giving the loan directly to the end customer. And they can't do it because they're not an NBFC. What happened then was the shutdown. So the shutdown is the alternative, right? Because you come to a point where it's not just that I lend less, but in effect, you'll close the business. That is actually, that is, I think, one of the problem. And one of the issues that has been happening in general were that banks were not giving small ticket loans. Why did a Zest Money become popular? Is because I wanted a 10,000 rupee loan. I wanted to buy a product and pay for it over a period of say 6 months rather than all at once, because it makes it more attractive. Charge 1,25,000 rupees for an iPhone. You end up with a situation where the iPhone itself becomes unsellable. But say I'll charge you 10,000 rupees a month for a year or 12,000 a month for a year, then people are like, oh, okay, I can do that. These are effectively loans packaged as payment programs, because it's not Apple that's giving that's willing to take that risk. It's an NBFC that says, fine, we'll pay Apple up front, but you pay us over a period of 12 months and we're fine with that. This whole ecosystem gets disrupted massively. Now, why won't bank give small loans of say 20,000 or 11,000 rupees? Because the cost of fronting that loan, the origination costs for the loan are so high that it doesn't make sense for them to lend at less than 50,000 rupee personal loan, 20,000 rupee. So anything that's 5, 10,000, this buy now, pay later, relatively short-term loans, they are like, listen, we don't want to do this. Now, the only way they could do this was through credit cards, because credit cards already has a obtained credit limit and so on. So they were doing it through the credit card framework. That also, increased to a large extent. You end up with having that being too high. Now, what RBI has done is the equivalent of a small forest fire. Now, in places where forests catch fires, if the fire gets too big, it is impossible to control. Forest fires are anyhow very difficult to control. So, but if they get too difficult to control, they will go and burn the houses that are on the periphery of the forest. So what the forest officials do is light small fires. Whenever the grass gets a little bit high and then a little dry, they start burning them down. So you'll see a small controlled fire, and that controlled fire ensures that there's no big fire. So essentially, you are burning down part of the forest, but you're burning down a smaller part and having a lower impact. So and RBI is willing to say, listen, if a zest money has to go, a zest money has to go. But we'll save the whole system from disaster a little bit further down the line as these loans grow. Because if you evergreen, a person who's borrowed 10,000 rupees will eventually end up with an outstanding of, say, 10 lakh rupees. And you will not have been able to recover from him because you never tried recovering the first 10,000 in the first place. As a system, you have become, much more worse that way. This BNPL part is also very interesting. So, for instance, Bajaj Finance has an EMI card. And they were allowing people to use that EMI card for a pre-obtained credit limit. Unfortunately, the way Bajaj Finance works is it cannot give a loan until that loan is actually dispersed, right? So they can give you a limit, but a limit is something that for which Bajaj Finance has to put capital against. So if they give you a card, they are saying, listen, now we're going to put capital against that card. We're going to wait till you actually take that loan. So effectively, you go to a shop, you go and use a Bajaj Finance EMI card and say, you know what, I bought something worth 8,000 rupees. Bajaj Finance says, fine, we have now digitally created a loan document for you. You have to just look here and say, okay, and we're done. So it's a new loan created for each purchase. RBI has a technical document that says if you give a new loan, you're supposed to give a bunch of illustrations. How much interest rate are you paying? What is the repayment schedule? What happens if you prepay? What happens if you don't pay? All of that stuff. This has to be shown to the customer at the point of purchase. Now, this Bajaj EMI card was being used online to make online purchases and instantly get loans. They were not showing people at the time because you're out there trying to make a payment. Are you going to read through a 50-page document? In fact, nobody reads through any documentation. But Bajaj Finance was not showing it to them. And they used this technical loophole in a way to go to Bajaj Finance and say, you cannot use your Bajaj Finance EMI card anymore. Now, that's a fairly large part of Bajaj Finance's business, so it does impact their growth. But RBI said, forget zest money. We're going to sacrifice that at this altar as well, because what you guys are doing is lending unsecured to people who just want to buy. And this BNPL concept is growing too fast for us to understand. You'll never be able to recover. For instance, the guy's bought like a pen for 4,000 rupees. He's putting it on his Bajaj EMI finance card. So, it didn't ban credit card companies, but eventually told credit card companies, instead of 100, you'll become 125, you'll become 150% risk weight. So hopefully that will slow it down as well. So I think that was the problem.
Okay. Two things came to mind for me in this. I'll start with the first. It's kind of linked. It's like, look, you gave Zest Money as an example or Bajaj Finance as an example. But what I'm thinking of is there's so many super well-funded startups. No need to name names, but there's so many well-funded. So if they are going to RBI and saying, look, I'm facilitating these loans because I have this great user experience and I have some knowledge about my customers as well. So I'm not like an idiot. I'm not just randomly giving people money. I do know who they are. They've been using my app for a year or two. And I have the balance sheet that can handle a wave of defaults. Why are you stopping me from doing this? I mean, what's your take on that? I mean, that's one. And the second one is, look, Bajaj Finance is a very, well-run company in so many ways, right? And it's grown so much. So the RBI feels like it's used a technical route to actually get around, I just don't like this. And this is just an argument I can use. But they wanted to kill this clearly. So I just wanted to ask, why is the RBI so, in this sense, why does it have such a different view than the companies themselves in this case? And who's right, perhaps?
Yeah, these are both very linked questions in the sense that, why would RBI stop a well-funded startup from effectively taking the risk, right? And second one would be about why does RBI have such a big problem when Bajaj Finance says, listen, I'm fine with this. Why do you have a problem with what I'm doing here? And the technicality aside, on the Bajaj Finance side, I think it's a little harsh because they went after Bajaj Finance in particular when a lot of the other companies were not doing equivalent things, and yet, a credit card company, for instance, is not doing an equivalent kind of a thing. But those guys are, there is, so the way BNPL works in general is that the merchant finances the purchase. Effectively, you're telling me if it's a 30,000 rupee thing. Let's say, Shrey, you want to buy this device I created and it's 30,000 rupees. But you're not going to buy it at 30,000 rupees. But instead I tell you, listen, it's 5,000 rupees for 6 months. You're like, okay, fine. At 5,000 rupees for 6 months, I'll do it. But who earns money here? There's no interest being paid, right? So what I do is I tell a bank, let's say a bank or an NBFC that decides to finance the customer, Shrey, you guys take the risk of Shrey paying or not paying. But assuming that the person pays, what I want to make sure you guys will get a decent amount of interest, right? So guess what? I'll give you a 2,000 rupee discount, which is about 6% on my 30,000 rupee this thing. So what I get from the NBFC is only 28,000. There's a 2,000 rupee that they will make in 6 months that translates to roughly 28% IRR for them. We've written a post on this as well. But the idea being that the BNPL concept is up to 6 months, maybe 3 to 6 months. The vendor of the manufacturer of the good will say, I'm willing to take this 6% or 5% hit. When you increase the risk weight, the amount of interest rate that you need to earn from that loan goes to an even higher rate. Like I said, I want to earn the same ROE. Now my risk weight has increased. Now I either have to charge a higher interest rate or lend to someone else who will give me a higher interest rate. So if I'm going to charge a higher interest rate, I have to go back to the manufacturer and say, listen, what, instead of 28,000, can you take 27? And I'll be like, no, I can't take 27. That's my limit. At 28, I'll be okay. But at 27, I die. So a lot of people who are maybe on Amazon selling these things or on Flipkart selling these things and assuming that the bank and NBFC will take care of this. When the banks and NBFC says you guys have to take a bigger hit, they will say, I won't do it. And guess what? Their products were only selling because there was an EMI option available. So they stop selling those things down the line. Now what RBI is seeing is on a completely different perspective. They're saying, listen, you guys exposed yourself to this evergreening concept, to this extremely fast growing concept without paying any heed to recoverability. There are two parts of it on the recoverability front. You may have capital, but that capital can get eroded very fast if people borrow it and then don't pay you back. You had at some point the ability to raise capital. Today that ability to raise capital has reduced quite substantially because of whatever has happened in the startup market. Earlier, startups used to even say, let the NBFC lend. If there are any losses, we'll take care of it. So we will do a first loss default guarantee, which is FLDG, right? So the idea being, you know what, you lent 100 crores. We don't estimate that there'll be more than 15% losses here. So here's a 15 crore rupee fixed deposit. Whenever there's a default, just take it from here. So this is a first loss default guarantee in some kind of a way. Eventually, even that deposit wasn't required. The startup said, listen, I have tons of money and people are just dying, tripping over themselves trying to give me more money. So assume that I'm giving you a guarantee for this thing. So this...
It was a handshake.
It was a handshake. And sometimes written handshake, written agreement as well. So RBI then went back and said, you can't do these things. I gave NBFCs the lending license because they were taking the risk. Now NBFCs are like, listen, somebody else is sourcing the customer and they're also taking the risk. So why should I care? I didn't give them the license. I gave you the license, the NBFC. So you guys take the risk. So don't pass on your risk to somebody else. Therefore, don't do an FLDG. So FLDG by startups went away. So then there were softer ways to ensure the same thing. There was something called, a bunch of things that came around this whole thing. But what this actually eventually happened, or where we went beyond this, was that startups now started to lend. Now, some startups even today lend from their own book. That means some startups are payment startups. You can pay after 15 days. Those guys are actually lending from their whatever money they have taken from their investors and giving customers the ability to pay at a later date. The unfortunate problem with something like this is that it doesn't scale. You can't keep taking more equity and growing using only more equity. You have to borrow from the market and then lend that out. So you borrow from the market at maybe 8 to 10 to 12% and lend out at 15 to 18%, make the spread, and that spread will pay for your costs, for your taxes, for your provisions, and some parts are loan defaults, and then you make some money out of that. This idea that a banking system exists on borrowed capital is where leverage is. RBI's issue comes from that I can say yes to you today because you guys have hordes of capital. But you guys will go also lend like 10x that capital. Then you reach a point where you don't have enough capital. And if you're not regulated by me directly, you're a startup and not an NBFC, then you will kind of throw your hands up in the air and say, I'm sorry, I'm done. And then guess what happens? Now I have to deal with the banks that have lent to you who are saying, listen, you let that NBFC go mad. Now we are suffering because, you regulate us so much. Why don't you regulate them? So that level has changed. Now, it's interesting because RBI has also changed another thing. And while I talk to you about risk weights of personal loans changing, we know that NBFCs give loans to individuals. RBI has decided with a very broad brush that all NBFCs are lending to people, individuals, and they're probably doing all this unsecured loan business. But where do NBFCs get the money from? They borrow from banks. Now, earlier, RBI's problem was that, listen, we were over-regulating this business. Because when a bank lends to an NBFC, we ask the bank to keep a certain amount of its capital. There's a risk weight attached to an NBFC loan. Then the NBFC lends onwards. The NBFC has to keep its own capital as well. So you're keeping capital at two levels for effectively the same end use of a loan. So they said, you know what, if you're a bank and you lend to an NBFC, then have a much lower risk weight. 20% if the NBFC which you have lent to is AAA rated, like HDFC was or Bajaj Finance is. If it's AA rated, like Manappuram is and so on, then you will put 30% of your capital. That means risk weight is 30%. So you give 100 crores, 30 crores is assumed to be lent out. 50% if it's A, and anything below that is 100%, and it goes to 125 and so on. So that was the framework. Now they've said take all these numbers, add 25 to them. That means if you're AAA rated, earlier it's an NBFC was AAA rated. Earlier it used to have a 20% risk weight. Now it will have a 45% risk weight. Then something that had 30 is... So when a bank sees a higher risk weight, what do? They increase the interest rate on that loan because, as I said, it ties back into their ROEs. They want to maintain their ROEs. They want to maintain their return on assets. Or actually, they want to maintain their ROEs more than return on assets. They say, listen, same loan, just now, if I lent it to you yesterday at 9%, now you're going to have to pay me 10% for that loan. The cost of funds for the NBFC goes up, and therefore NBFC themselves want to keep their ROEs high, so they want to therefore keep their interest margins roughly the same. Therefore, they raise the borrowing cost for the customers. There was a recent article about how quietly banks have started to increase loan rates on everything. It has a downstream impact on everything because even housing loans and car loans are seeing an increase in rates. So have personal loans already, by the way. So you end up with a situation where the RBI's problem has resulted in a higher borrowing rate for startups, higher borrowing rate for the end user individuals who are trying to borrow these things. And for as simple a concept as, listen, you have you're growing personal loans too fast. One thing I think we haven't done, and maybe this is a bad thing, and maybe it'll help you. I mean, if you look at the way RBI is looking at these things, they're looking at system stability, right? So you're thinking, listen, if this person who's taken a 5,000 rupee loan, if they default, where are you going to be able to recover it from? But the counterpoint is, why can't I give a 5,000 rupee loan? It's digital. Everything's digital. The guy has to just answer a few forms. I can find. So there are three C's in the lending business, right? Collateral, credit worthiness, and what we call capacity, which is your income. So if you have the income, you have certain collateral against the loan. A housing loan will have a house as collateral, etc. And if I know that you've been credit worthy in the past, that means you've paid back your loans in the past and so on, I can give you a loan. So there are three C's. Now you can make it go down to two C's. That means I analyze your income and your credit worthiness. Then maybe you don't need collateral. So if you have good income, and I know I can see you getting good income, and I can see that you have credit worthiness, that means you paid in the past, then I can still give you a loan. Two, what current startups and all were doing was doing only one. They didn't have any way to assess income. They were saying, oh, your credit score is 780, that's fine, we'll give you a loan. The credit score became the sole criteria, not income. because they were incapable at the time of handling, looking at salary, where people's salary is coming from and so on. Whereas in the earlier days of paper processes, they would ask for your bank statement. They would look at the bank statement and see are there regular credits coming in from a salary place. So they could analyze where your income is actually coming from. So because this has changed and people went into this 1C kind of thing, RBI has gone the other way and said, listen, you have digital, but you guys are using, you're ruining the system by going down to pure digital. So we kind of reduce the loans. But I have this question, and I don't know what if RBI's worry is that this is creating a problem in terms of not being able to recover these loans, or people are doing bad lending. On the other hand, the startups are saying, listen, there's so much demand for these small ticket loans. Why are you stopping us? Why can't the startups, for instance, say, give me your mutual funds as collateral and take that 4,000 rupee loan? I'm sure you have 50,000 rupees of mutual funds. And even that can be done digitally. Why can't you do this? And I don't understand that part. And maybe that is something that we should explore.
So I'm now that you bring it up, and that was actually going to be my question, is that do you think that the consequence of these actions, I guess in the short term, is that some types of loans will just become more expensive and there'll be fewer of them? But equally, would it be that people come up with smarter and better ways to lend? I mean, do you think that's like, in fact, while you were saying that, I kept thinking there's been such a massive bull run over the last 3 of the last 4 years or something like that?
7.
Wait, really?
It's been 8 years in consecutive
Good Lord.
succession. Yes.
So given that, shouldn't loans against securities also be having these crazy growth numbers that you were talking about? But
that is absolutely true. You know what? In the last 8 years is when the changes happen, and perhaps the startups themselves are a little slow to recognize this. Today, you can have a mutual fund. You can have a digital lien on it, a pledge effectively on it online. That means you're not going to be able to sell those securities unless that lien is taken out. And a person and many banks, one bank, maybe a couple of NBFCs have the digital capability of giving you loans against your securities or your mutual funds. Why are they not doing it now is, I think, they're greedy and they're lazy. There's a lot less awareness about this from customers. So what I really think is a big deal here is you do the same buy now, pay later concept, but with loan against securities instead. Take my mutual funds, give me a line of credit. Now I can use that line of credit whenever I want. You have that entire line secured against my mutual funds. Give me a card against it if you need, but when I use that card, it should be a loan against my securities that is being kind of utilized rather than anything else. It's going to be the same interest rate. I know it's going to be the same interest rate, or whatever interest rate I actually charge. You could literally say it's a 0% interest rate on products that I buy from Amazon or from certain types of vendors if you take a 3-month loan. Now this is fantastic because if I use the loan and I don't pay it back, you don't have to recover it from me. You just sell my mutual funds. And that, I think, usually people are trying to solve cash flow issue. You're trying to tell people that you don't have to pay all of the cash right now. You can pay it over a period of time. They don't have a problem taking credit. It's just that they feel better if it is a loan that's payable over 3 or 4 months. If you're trying to solve a cash flow issue, and people don't have a problem giving you collateral, why aren't you merging? It's a great idea, I think, to be able to do this. And we've talked about it in a bunch of...
So as securities become, stocks, mutual funds and the like become a bigger part of balance sheets than they currently are, this can become the new, or for at least a wealthier section of society, this is the new loan against gold or gold loans, right? I mean,
yes. In fact, I would say because it's so liquid and gold has this problem of impurity, you can't have an impure mutual fund. If the minute the mutual fund has told me you have these units, that's the, other than if the mutual fund goes and screws up. Right?
I'm remembering a podcast you recorded on someone who did screw up, but I take your point. Yes.
Yeah. I think that has, so at some level, mutual funds themselves, if you can trust the system and they're easily sellable and they're easily recoverable, you should be able to use this. In the US, you have something called home equity lines of credit. So if you've paid back a certain portion of your home loan, then the portion that you've paid back becomes available for another loan on top, which means that you can say that I have an actual fixed mortgage of about 4%. and then I can have another one on top, which is a 7% or 8% loan, but that I can use for my temporary stuff, like something that I need to buy only for 2 or 3 months and so on. So imagine doing this now with a credit card. With instead of a credit card receivable, you do it with a lending against securities instead. Isn't this also better? Because the problem with lending against securities is people use that loan to buy more securities, right? So you double down. You say, I'll buy 10 lakhs worth of securities. I will pledge those as margin and buy more stocks. So now I have 15 lakhs worth of security. Then I buy 17 lakhs. So the problem with this is never ending. And banks actually have agreements that say strictly do not do this. But exactly what they tell you strictly not to do is what people do. So instead, if you use the loans against securities to buy things on Amazon and Flipkart and maybe a offline retail and Agio or whatever, it creates the mechanism that says he's actually not using it to buy more stocks. He's actually using it to do consumption, which is exactly what loan against securities was meant for. It was not meant for you to start a business because it's a personal loan. It's not a business loan. It was meant for you to finance your consumption. But there's also the small aspect of things, which is that if you have a short-term requirement and you have a very long-term held mutual fund, selling that mutual fund for those 3 months that you need the money and then putting the money back once you've earned it actually has a tax disadvantage to you, because you'll pay tax on whatever you exit. That 10% tax can be a significant number, but let's say most of your whatever you earn out of the thing is profit, and you sell it and then you take the money, you pay the 10% tax on it. After 3 months you put the money back in. You have to put back, you can only use 90% of the money because 10% is gone in taxes, and then you have to put 100% of it back in a few months. What's really happened is you've actually paid interest in the form of tax to the government. The interest rate for that may actually be higher than the rate you'll pay for an equivalent borrowing for those 3 months just for the time pass purposes, in the sense of using the money for a very small period of time. If you did this, you could have the loan against securities just offset the taxes at that time.
I just last point on this is I vaguely remember hearing about this was done expressed in a very negative way, that billionaires and very rich folks in the US were using basically loans against securities as a way to not have to pay taxes, because they'd take the loan, spend off the loan, and then I guess use the securities to settle it at some point on their death or something like that.
Well, the idea is the securities go up at the faster rate than the rate of interest on those loans. Remember, for the longest time in the last 10-15 years, you had very low interest rates. So if your securities were going up at 8 or 9% a year and the loan interest rate was 2%, you simply took a loan against those securities and said, yeah, your 2%, don't worry, I'll cover it. But I'm getting an 8% or 9% increase in my assets every year. It's when interest rates go up to 9-10% is when they're like, oh, okay, no, we can't
do this anymore. Okay, sure. I think I'm ready to move on to the second thing that RBI had done, which was on that AIF one, which on the face of it feels that you should be, I mean, completely I get your mixed feelings about what has happened so far, because yes, it's a problem. Yes, we have to tackle it, but as always, the solution has its own pain and its own downstream consequences, which may not be understood and might be covering too many loan types. But on this AIF one, surely this is a more unambiguously positive one, right? Or I'm waiting to hear what you have to say, because it sounds about right that, yeah, you give a loan to someone and then you only float an AIF, which then goes and bails it out. Surely this is a bad practice and we should put an end to it. But do you see it differently?
You have absolutely hit the nail on the head here. I think the idea of evergreening has come. In fact, why do we have NBFCs? Why do we have a non-banking finance company? It makes no sense unless banks were saying, listen, we're very highly regulated. Every time somebody doesn't pay us for 90 days, we're screwed. Oh, guess what? If you're an NBFC, you can go up to 180 days without saying that somebody hasn't paid. So why don't I create an NBFC and make the NBFC lend back to the same entity who then uses that money to pay me back? So I've just transferred the loan from me to my own NBFC. Which is, by the way, why a lot of if you take a housing loan from, say, an ICICI, the housing loan does not come from ICICI. It comes from ICICI Home Finance, which is a subsidiary NBFC of ICICI Bank. If you go till a few days back, if you went to HDFC Bank and tried to get a home loan, HDFC Bank would not give you the loan. It would be HDFC, which is an NBFC. Of course, that's an NBFC that owned HDFC. Now they have merged together. But The idea of this NBFC was that the regulations gave a little more leeway to an NBFC. So banks would float an NBFC and lend through that. Over time, RBI discovered that there's a lot of crazy things happening on the NBFC side, which they wouldn't allow a bank to do. And since the bank was the owner of that NBFC, the bank was also passing down loans to NBFCs themselves. They said, we'll equate the two, and now they have placed so many regulatory hurdles on NBFCs that they're regulated almost as much as banks.
Or at least the large ones, I guess.
At least the large ones. The large ones are at least, to that extent regulated more. So people are like, listen, humans are, in Indians especially, we find loopholes in everything, right? So we kind of do this, what's next after this? So they found out there's a vehicle called an AIF. Now, earlier they did this with mutual funds, and we'll come to that. Mutual funds, of course, they screwed up in another way. But banks said, let's give somebody else the money. That somebody else needs to be less regulated. Think of earlier as a mutual fund as an option, right? A mutual fund could effectively lend money to a company. The bank owns the mutual fund. The mutual fund, how does it lend to the company? The company issues debt securities. The mutual fund buys those debt securities. So then the company gets the money and transfers it back to the bank. Bank has no problem, except the mutual fund unit holders are the mass public. And at some point, they're like, why are you giving bad debt to us? Soon, people discovered that this is not palatable. JP Morgan discovered there was a mutual fund called JP Morgan Mutual Fund, floated by JP Morgan Bank. Now, I suppose this stuff is very common in the US and all that, because honestly, I don't think very highly of their regulatory systems in terms of risk control. But they floated a mutual fund here. They did some stunts with this. There's a company called Amtech Auto that defaulted to the JP Morgan Mutual Fund itself. And then investors were furious because they were like, they weren't able to take their money out, and the company had defaulted. SEBI started to institute rules against this. In COVID and before COVID itself, there was a big default by the Z promoters. The Z promoter default and the ILFS defaults hurt the mutual fund industry big time, because ILFS itself was borrowing from the mutual fund industry. ILFS should have been borrowing from banks, or should have been was earlier borrowing from banks itself, but it moved some of that borrowing to mutual funds at very high rates. Mutual funds loved the high rates when they came, did not like it when nothing came at all, and eventually people lost money. SEBI then tightened the noose even more and then said, listen, if you're taking public money, you can't be doing these kind of indiscriminate lending, and then they changed the rules. Now, mutual funds were no longer allowable for evergreening, right? Later, Franklin also happened. We would come to that, but it was a liquidity issue more than it was a credit issue. But still, the idea was mutual funds were no longer a route for evergreening. Enter the AIF. AIF is an alternative investment fund, SEBI regulated vehicle. Take the same concept where the company issues bonds. Many real estate companies, for instance, they buy land. Land is lent. Banks cannot lend against land. So NBFCs lend against land. So they take money from, and that land may not be, developed for maybe a decade. When NBFCs lend against land, the company may not be able to return that money in any meaningful time frame. At a certain point, the NBFC will say, the real estate developer will say, listen, I know that loan has come due, but I can't repay it. Can you just move the loan, another 6 months or another 5 years? And you do that, it's called restructuring. If you restructure loan, the NBFC has to take a higher provision, it hits its profits, therefore its risk returns, all that stuff. If it has to find a way to get it off its books. So it floats an AIF. So it creates an AIF registered with SEBI, makes the AIF buy bonds of that real estate company. When the company receives money for those bonds, it will then pay back the RBI not pay back the RBI, but pay back the bank or the NBFC directly. This is a downstream. So what changes? AIFs not required to recognize the changes in that company's debt profile for as long as 8 years. It can say, well, you know what, they're going through a bad time.
Leave 90 days, 180 days. This is 8 years.
8 years. So it could actually literally downstream it down for 8 years. RBI saw this problem happening because a bunch of people started writing about it in 2021 and 2022. But what was the problem? The problem was very simple. I bought an AIF. Now I tell I can't. If let's say I'm an NBFC and I have given a loan to ABC developer, I create an AIF and make it buy ABC developer's debt. Now, technically, the risk is still mine. But SEBI has rules that says, well, more than 40% cannot be owned by one entity. So how do I get another 60% of money to come into that AIF in the first place? I'll tell the AIF, listen, we'll create the money. We'll use 40% of the money to fund, the debt that I have passed on. But the remaining 60% will buy better debt. But then if you're being pitched this AIF, you'll say, Deepak, why will I go into this AIF if 40% of it is shitty debt? So I'll tell you, listen, Shrey, just between us, we have an agreement in the AIF which says if this debt goes bad, which is this 40%, then I'll take the hit. I'm a junior tranche of the AIF. So I will take the hit on those 40%. The remaining, after that, if anything happens, then it's for you. So look, this is a good deal because the bad stuff I don't want, and the good stuff is what I'm going to end up getting, and I'm going to earn the interest rate if by any chance the bad stuff becomes good stuff. So it's like upside is mine and downside is not so bad. So you kind of invest in it. So a lot of people started to do that, especially from people from abroad. So big names, nice looking acronyms, I won't name them, but they all started to invest in these AIFs and saying that the banks and NBFCs have a explicit, not implicit, explicit guarantee on losses that are happening. SEBI said, no way, you can't have two people in an AIF with different risk profiles who say that, oh, this person will take the first hit and then this person will take the hit only afterwards. I will disallow tranching and creating mezzanine tranches inside of an AIF. They did that last year. But SEBI can only do that, right? Because they can't do anything on the NBFC end because they don't regulate NBFC. So they went to RBI. RBI said, okay, well, fine, we'll regulate these guys. And they start to see this over a period of time. And then what RBI said was, wait, are you telling me that the NBFC creates an AIF, buys into the AIF, and then that money is somehow routed back and the loan is transferred off the books of the bank or the NBFC? Let me now break this chain and say, if you invest in an AIF and then that AIF invests in a company to which you had given a loan in the past 1 year, then I assume that this is evergreening regardless of what has happened. Maybe you were the nicest guy in the universe, the borrower was the nicest guy in the universe, but I'm still going to assume you guys are evergreening the stuff. So either you get rid of your AIF units within 30 days from now, or you ask that AIF not to invest or to cancel its investment in that company, whichever company it is. So now imagine that this is already in place. The hurdle now we're reaching that 30-day point right about somewhere in January. We're in January of 2024 in case you're listening to it at a different time. But in this month, you're going to have to find these sponsors or the people who have actually invested into these AIFs, the banks and the NBFCs, have to find ways to exit their investment within the 30 days that they've been given. Because you can't go to a company and say, pay back my loan, which I've already given you, although I own your bond, which is maturing 5 years later. It's not possible. So, but this has a downstream impact because let's assume that SBI invests in an AIF created by SEDBI. SEDBI uses that AIF to invest into startups. One of those startups goes to SBI and says, sir, will you be my bank? And as long as they only keep money in the bank, they're fine. But one day that startup says, can I get a credit card from your bank because I need to pay my bills? I'll pay back the credit card, no problem. So the minute they give a credit card loan to that entity, now they have what is called exposure. So SBI has exposure to a startup which is invested in by an AIF in which SEBI has an investment. Now SEBI has to either cancel the loan to the startup or make the AIF sell their startup shares or sell their units which they own in the AIF. So once you have to break this chain, you end up with a situation where, the startup got screwed for no fault of their own. So this is the downside of this regulation. But the upside of it is now that they have discovered the evergreening early enough, I think, to avoid damage. But in the short term, it will create damage.
I'll go to my last question for the session today, which is all the stuff we've spoken about today. Is it all just like the RBI getting ahead of the curve and saying, look, I'm feeling the economy is overheating. This is a warning sign. So I'm just going to go and try and deflate this before the economy actually overheats. Because that's the vibe I've been getting throughout our conversation.
It is. In fact, I think the RBI takes this stuff quite seriously because of the things that have happened in the past. And in the past, we've had a lot of oversights in the banking system. They have fought and brought the banks down to a point where they can actually regulate them. To a large extent, they weren't allowed to replace directors or the board of a public sector bank until recently. They fought for that. They can do it for private banks. But if you go to a public sector bank and say, don't lend to these corporates, and this public sector bank to look back at you and say, or what? And then you don't have an answer to that, you have a problem as a regulator, right? So now they got regulatory powers to be able to regulate these banks properly. So they've said, listen, now we'll use those powers judiciously and try to identify problems early. Inflation, unfortunately or fortunately, is actually not very high. So we're not overheating in any meaningful form of the exercise, but we may have pockets. So I don't think it's a systemic problem yet, but it is probably a very siloed pocket in that sense. Now, because RBI is already regulating NBFCs like banks, that regulatory arbitrage is gone, we don't see we've seen that regulators often come really hard at stuff like this. There was a case, for instance, where mutual funds at some point were dumping debt in what are called fixed maturity plans. Fixed maturity plans are like, if I buy a plan for you for 3.5 years or 4 years, you get some indexation and tax, right? So what happens with that is you can buy an investment today and get an exit 3 years later, but you get 4 years of indexation, and that 4 years of indexation allows you to get almost all the proceeds free of tax. This has now been plugged, but at some point in time, if FMPs are very, very popular. When FMPs are popular, what they do is they buy money, they buy investments for exactly 4 years or 3.5 years. And when the maturity comes, they are able to take the money and go on. But they get intermediate payouts. Those payouts generate cash in those FMPs, and sometimes that cash is invested in something really liquid like a overnight thing and all that stuff. What certain NBFCs were doing is taking their own, they were sponsors of mutual funds themselves. They were passing on the debt to these mutual funds and which were dumping them into FMPs. And then somehow what happened was, the problem was in one of the biggest names in the country where they dumped some debt into an FMP and that debt defaulted. When the FMP holders got to know, they were furious, but there was nothing they could do. They were like, we trusted that you will keep this money safe, but invested in relatively safer debt, but they had done the exact opposite. So RBI kind of broke down that along with SEBI. SEBI said, listen, you can't do this dumping of assets into FMPs just like that. So we're going to change the way these sequences are. I think RBI has done exactly the same thing over here, assuming that this can become a bigger and bigger problem from the AIF end, to a point where there will be a lot of developers, and if they can't pay that system, that will become too big a problem for us to solve. Here is where I think AIFs are a good thing in general. They will actually expand the bond market. They are the equivalent of junk bond funds of the 1980s in the US. So they're the equivalent of Kohlberg, Kravis and Roberts, KKR. And Solomon and all of those companies in the early 80s that Michael Lewis wrote about in Liar's Poker. It'll help build out that market. But I also think that this is a little bit of an overkill. It's a little bit of a harsh attempt to get the market to go heal. One thing that you have to be careful of, and I'll probably end with this, and we talked about RBI, everybody's like, what difference does it make to me? The financial system is like this. They will take the risk as long as there's rewards, right? But when things start getting really bad, you're going to find that somebody is going to try to start to sell you a bad product. If a bank or an NBFC has to sell its units of an AIF forcibly because of whatever is happening, they might find a way to come to you dressed in suits and tell you, we have this great AIF that's been doing really well in the last 10 years. You have no idea what it does, but you could actually go and say, well, you know what, it's been 9 years and there are some units available. Why don't you buy them? It's only 1 crore minimum per person. And to the relatively richer people who have grown to trust banks and so also mistrust them, they may be looking at this as a great opportunity. But in reality, it may be the downstream impact of this RBI regulation that is forcing an NBFC to sell units of an AIF, which are actually more toxic. And therefore, the guy who's buying them, who is not aware that it's so toxic, will just buy them just because of, say, past performance over the last 1 or 2 years. So if anybody comes to you with AIF units selling debt, you want to be a little more careful about what has happened. And perhaps you've already gotten into it, there's nothing you can do about it, so ignore that. But at least going forward, you want to be a little more careful on when you buy AIF specifically on debt. And I say this very meaningfully because we are biased. We have an AIF that invests in equity. So we are not going to be part of this enterprise. So, but AIFs that sell debt, that might be a challenge.
Something to look out for. So that's the warning to start 2024 with. So thanks, Deepak. Thanks so much.
Thank you so much. Good fun.
Well, thanks everyone for listening. Do visit capitalmind.in to learn more about and see if you're interested in our subscription service where we share research ideas with you, or our PMS where we manage money for you with a 50 lakh minimum. Thanks.